Hello guys, so today we are going to talk about study unit 3, and in study unit 3 we have different topics. Topic number 3.1 plus 3.2 plus 3.3. These three topics are relevant to accounting for investments. And topic number 3.4, it is about property, plant, and equipment. And topic number 3.5, it is about intangible assets. So we are going to cover this portion today. Accounting for investments. So here we go. So first we need to understand what is investment. Investments mean to say like when we buy the debt securities or equity securities of other company. This is called what? Investments. For example, you are working in company A, maybe you are working in finance department, you have some spare money to invest. So what you are going to do, maybe you are going to buy debt securities or equity securities of company XYZ or any other company. So this is called your investment. From your point of view, it is investment. Now debt securities mean to say like especially when you buy the bonds of other company or preferred stocks of other company. This is called your debt securities. And equity securities mean to say when you buy the common stocks of other companies. Common stock is also called ordinary shares, right? So this is what is your investment. Now here we go. First, I'm going to start with investment in equity securities. Right? Because from accounting point of view, preferred stocks we will categorize as investment in debt securities. So here we go. I'm going to start with investment in equity securities. So what does mean by investment in equity securities? I need your concentration now. It will become very easy if you will understand. Investment in equity security means when we buy the common stock of other company. That is called what? Equity securities. So guys, accounting for equity securities depends upon the classification, like in which classifications or in which category you are falling. So first of all, when you buy the common stock of other company, you can look at here this table. On one side, we have a percentage of ownership. This column is for percentage of ownership. Ownership means your voting rights, like how many voting rights you hold. Second column is for presumed influence, like do we have influence over investee or not. So what is influence? That I will explain. And third column is for what? Accounting methods, like which accounting method you will follow or you will use. So starting from here, for example, guys, when you buy the stock of other companies, common stock of other companies, and your voting rights are between 0 to 20%, like it means you own any X percentage between 0 to 20% of the voting rights of other company. So it means you have little or none influence. Little or none influence. Little means say maybe you are not the major stakeholder in decision making, right? So either maybe if you have 18-17%, so you are not going to be a major decision maker of the business. So you have a little influence and non-influence. Maybe they will not even consult with you. So that is why it's written none, right? And here for accounting purpose, which method we will use? We will always apply which method? Fair value measurement. Fair value measurement we will apply. Okay. Second category is what? If your percentage is between 50 to 20%. In between, it could be 21%, 25%, right? 40%, 49%, right? So then it means you have what? Significant influence over the investee. Significant influence means to say you have a power to participate. I'm not saying you have a power to decide. I'm saying you have a power to participate in financial or operational policies of the investing. Like you are a major stakeholder, but you are not the ultimate decision maker. Right? So you have a power to participate in financial and operational policies of the investing. And here, guys, for accounting point of view, you got a two option here. First option, either you can follow which method? Equity method of investment, or you can follow what? Fair value option. This fair value option and fair value measurement, it is same. Why it is called a fair value option? Because, guys, at election date, because it is one of the accounting policy, you got a choice to do the accounting, especially if you are having significant influence. So at the election date, top management or the board of directors, whoever is senior, setting the accounting policies for the company, he has to opt. He has to opt either equity method or what? Fair value method. But it is similar to the fair value measurement. Fair value option is similar to fair value measurement. And third category is what? When you hold any percentage between 50 to 100, like maybe you hold 51%, 99%. So it means you have control over the investee. You have control over investee. What does it mean by control? Control means you have a power to decide financial or operational policies of the investee. Like you are the major decision maker. For example, we are running a business. One person, he owns 55% stocks. Other person, he owns, let's assume, 45% stocks. Majority is the authority. This is what we consider, right? So the person who will take the decision, like the person who owns more than 55% or more than 50% of stocks, he will be the decision maker because he is holding majority of the voting rights. And here which accounting method we follow? We follow what? Consolidation. So today our point is not to discuss about consolidation, no. Our topic is to discuss about what? Equity method, fair value option, or fair value measurement. This is what we are going to discuss. So here we go. First, we are talking about measurement of an investment in equity securities. Like as I told you, we always follow which method? Market value methods, fair value measurement, right? So there you could have two scenarios. Obviously, this scenario is obvious, which will be given in the question. And this scenario is just based on your some estimates also. Scenario number one is what? For fair value measurement, we are talking about. Scenario number one, if the market value of the stock in which you have invested is readily available. Maybe that company is registered on the stock exchange in which you have invested and stock price is available, readily available, right? You can get access anytime to the price of the stock, right? Anytime because it is listed company. But second scenario is what? If market value is not readily available. Maybe you have invested in small companies whose stocks are not listed, right or wrong? So maybe the market value is not readily available. So guys, if it is readily available, we will use which model? Fair value model, right? So if it is not readily available, but we are bound to show the investment value in our balance sheet, so then we will use what? Measurement alternative, right? Starting with this scenario, if market value is readily available. So which method we are going to talk about? Fair value model. It's not hard, it's very easy, just I need your concentration. So guys, what does mean by fair value model? Couple of points we need to understand. This could be written also fair value through profit and loss account. Fair value through profit and loss account, what it means. So guys, in balance sheet, in balance sheet, we have to record our investment as asset. Current assets and non-current assets, it depends on your intention, like for how long you want to keep this investment, right? Is it current or non-current? It depends. But we will record this as investment into which section? Into asset section of the balance sheet. And at which value this investment will be recorded? This will be recorded at what? Fair values. At which date? At balance sheet date. For example, I bought the stock for, let's assume, for $10. This is what is my purchase price. Now at the end of the first year, this is first year end. At the end of first year, stock value is, for example, $12. So you can see there is a gain because stock price has increased. Gain of how many dollars? $2. This gain, there could be a loss also, you know. Maybe if stock price is $8, there could be a $2 loss at the reporting date. So this gain or loss, we will always take to the net income. Net income, it's say in which statements? In the income statements. Please make sure, guys, there could be two types of gain or losses. One could be realized gain or loss. A second could be what? Unrealized gain or loss. What it means? For example, let me give you example. I bought the stock for $10 and then I sold the stock for $12. So there is a gain and I got this gain in cash. So this $2 will become realized gain because it got in cash. What is unrealized? If you bought the stock for $10, now stock price is $12, but still you hold this investment. Right or wrong? But there is a gain of $2, but you didn't sell, so you hold it. So this $2 will become now unrealized. It is not realized. Clear? So gain or losses, we will take always to where? To the income statement. How you will take that, I will show you, don't you worry. I'm just explaining theoretically. Understood? Point number 3, because when you invest in the common stock of other company, you might receive somewhat dividend on that. So dividend received is your going to be income. So if it is your income, obviously this will be also recorded in income statement. Understood? So then what we have here? Cash flow effects. Right? So is it going to be your investing activities or it is going to be your operational activities? Right? So it depends again. Right? So cash flow from purchase, whenever you buy, it is outflow. And whenever you sell, it is your inflow. In equity, securities are classified in statement of cash flows based on nature and purpose for which the securities were acquired. Maybe it could be for day-to-day purchase and sale. Like for example, you are a bank and this is your normal operations, right? It could be operating activities also. But normally we will write under which activities? Under investing activities. Because mostly we buy with intention to get gain in long run, right? So that will become your investments. Okay, it depends. So it means there is no specific guidelines. It depends upon the purpose and nature of the investment, right? So what we have done, what I have said, I said that in balance sheet, you will record your investment as asset at fair value, right? Whatever the value is prevailing at the market date, at the balance sheet date. In income statement, you will take realized or unrealized gain or losses, you will take it to the profit and loss account, to the income statement. Dividend, if you are receiving, that will also be taken to the income statement, right? And in cash flow statement, is it your investing activities or operational? It depends upon nature and the purpose of investment. Okay. Now, here we have a couple of entries, journal entries, right, about fair value model. Number 1, guys, when we buy the stock, whatever price you have paid, right? So what we will do, we will debit the investment account with the price paid and we will credit the cash account, right? For example, you bought it for $10. So you will debit investment with 10, credit cash by 10. Now guys, here second entry is for reporting date. Like at reporting date, if your market value is different than investment value, for example, market value could be 8 or 12. So you could have loss or gain. If it is a $12, it means there is a gain of $2, right? Because you bought it for 10 and now price is 12. So there is a gain. It is unrealized, I'm assuming, because you hold it. So we will debit what? Investment account by $2 and you will credit what? Unrealized gain, which will be taken to the income statement by $2. Initially, your investment was recorded at what? $10. You will add here because again investment is debit by 2. Automatically, it will reach to $12. Understood? And this gain you will also take it to the income statement. What if there is a loss? Maybe you bought it for 10 and now market value is $8. So there is a $2 loss. So what we will do, guys, we will debit unrealized loss, which will be taken to income statement and credit what? Investment. Right? Now, previously, if you bought it for 10 and now there's a $2 loss, obviously your investment will be reported at market value. Understood? Now, guys, third entry is for what? Dividend, which we have received. So if you have received, you will debit the cash. If you have right to receive, like you are entitled to receive, you will debit the dividend receivable and credit what? Dividend income, which also be taken to the income statement. Clear? And the last entry, when we sell the investment. So obviously it's normal rule whenever you sell any asset, even investments. So you need to remove the portion of investment which you have sold. If you have sold entire investment, remove all. If you have sold some portion of investment, remove that portion. And second thing, you also need to record the cash proceed, which you will receive through the sale, right? And the result would be the gain or loss. So this is what is the entry we are going to discuss. First of all, we will debit the cash with the cash proceed which you have received. And we will credit the investment with the carrying value which is showing in the balance sheet. Why we credit the investment? Because we want to eliminate. We want to eliminate it is sold. That is where we credit it. And the difference, if the difference is coming on debit side, this is called what? Realized loss, which will be taken to the income statement. If difference is coming on which side? Credit side. This is called realized gain, which will be taken to the income statement. Understood? So these are the double entries. So I'm asking simple question from you. Whenever you buy the investment, your investment account is debit or credit? Debit. It means investment value will increase. And whenever you sell the investment, your investment account is credit or debit? It means it will decrease the investment value. Correct? So you should remember also effects of the double entries. Clear? Now here, this I already told you. In balance sheet, it's summarizing, and then we are moving to the example. In balance sheet, what we will record the investment at which value? Current market value. Right? Whatever the market value is prevailing at the balance sheet date. Balance sheet date is also called reporting date. And then, and this is how I can do shortcut also, because you're going to solve MCQs. Simply, you don't need to worry. Just you have to take number of stocks which you hold, multiply by market value per stock at the reporting date. So automatically you will get investment at market value. Understood? And then all gains, realized or unrealized, both, and losses due to changes in fair value will be taken to the income statement along with the dividend income. This is summary. So now we are going to perform a small example here. Let's understand how it is going to work. We have example here. Just go through with me, guys. So on November 1, year 1, A company purchased 2,000 shares of G company. It means A is the investor here and G is the investee, right? And these are common stocks. And what was the, obviously you bought at fair value, whatever it was prevailing on the November 1st, year 1. This investment is less than what? 1%. So if you remember the rule, whenever you hold the investment between 0 to 20%. So which method you have to apply? Fair value. That means fair value model we have to apply. Then they're saying the following are the fair values per share of G company. G company's common stock at relevant date. So here we have a couple of dates are available. First, year 1, November 1, year 1. This is actually date of purchase. You bought it for how much? $100 per stock. And number of stocks are how much? 200. Then this is 31st December, year 1. This is first year end. Year end. Market price became 90. And then we have 31st December, year 2. Like at the end of second reporting period. So your market price is how much? 150. So what you will do, guys? So first of all, add the date of purchase I'm talking about. And date of purchase is what? November 1st. So you have how much? $100 was the fair value. And you bought it how many stocks? 200 stocks. It is going to give you how much? $20,000. So what entry you will pass? You will debit investment and you will credit cash by 20,000. Then at the end of the first year, your stock price is how much? $90. It means there is a loss of how much? $10 per stock, right? Because price has decreased. So simply you will multiply with the number of stocks, which are 200. So it is going to give you 2,000. This is loss or gain? Loss. For loss, what entry you will pass? You will debit unrealized holding loss, which will be taken to income statement of 2,000. And credit will be investment account. Understood? Now tell me how your data will be presented in the financial statement in year 1. So you are preparing balance sheet. In balance sheet, I'm telling you shortcut way. So simply in asset section, you have to record what? Investment. Right? At which value at? Fair value at the reporting date. And how many stocks you have? 200 shares. And fair value was how much? $90. So it is how much? 18,000. And the breakup of 18,000 is what? Because initially you bought this investment for 20,000 and then you credit the investment by 2,000. So which is what? 18,000 and we got directly. Clear? Understood? Then what you have to do? Second thing. Now you have to prepare what? Income statement. Right? In income statement, you have to record gains or losses. So there is a loss, unrealized loss, which is $2,000. You can see from this entry. Clear? This is how it will be presented in the financial statements. Understood? Now, guys, we have another date. Then from at the end of year 2, the stock price is how much? 115. Recently, it was recorded at which value at? 90. From 90, it reaches to 115. So there is a gain of $25 per stock. You will multiply with the number of stocks, 200. It is going to be 5,000. Clear? Is it a gain or loss? Gain. So what you will do, you will debit investment by 5,000. Credit unrealized holding gain. It's a gain. Gain. So gain is how much? 5,000. Loss obviously will be deducted from income statement. Gain will be added there. right? And how you want to present in the balance sheet again, guys? So in balance sheet, again under asset section, you have to record what? Investment. How many stocks? 200 at the current market value, which is 115. So this will be, I guess, $23,000 as the investment value, whatever the value you will get. Just multiply. And then in the income statement, what you will do, guys? So there is a gain, which will be recorded how much? 5,000 gain as a positive value. Loss you will write as a negative value, obviously. Understood? This method is called what? Fair value method. Whenever it will be sold in future, what entry you will pass, guys? You will debit cash with the cash proceed. You will credit the investment with the carrying value, which is showing in the recent balance sheet. If difference will on the debit side, that will be a loss. If difference is on credit side, that will be a gain on disposal of investments. Clear? This is what is called your fair value model. And in your exam question, you are not required to estimate the fair values. It will be given, obviously. Right? So now here we have another method which is called what? Measurement alternative. Just theoretically remember. Measurement alternative. And first you should remember, measurement alternative method is applicable if stocks market values are not readily available. Not available, obviously. So then you are going for alternative method because fair value you cannot apply. Right or wrong? And for that, for it just a theoretically. So what is the formula which you will, what is the format which you will write, guys? So you will take it here. You will, this is the formula actually written here. You will take what? Cost of investment. Cost, you know, whenever you bought it, right or wrong, whenever you bought it, what money you paid at that time. Maybe you paid $100 that time. So that will become your cost. Okay. Plus minus what? Impairment. Impairment is what? Decrease in the value. Again, because stock prices are not readily available, so it will be complicated to determine. Right? And then there is one more plus minus for what? This is important. Changes resulting from observable price change for the identical or what similar investment of the same issuer. I'm just giving you example, guys, to understand. This is the shortcut format is written. The investment is measured as follow by using measurement alternative methods. First of all, you will take what? Cost of investment. What? Cost of investment. Impairment, as I told you, he will not give you anything about impairment. Otherwise, impairment is a kind of permanent reduction in the value of investment. Right? So this we will cover later, what is impairment, how it is calculated. But my focus is to just tell you measurement alternative. So to solve theoretical questions, you should remember this complete format. We will take cost of asset, investment, minus what? Impairment, plus minus. What's written? Observable price changes of the identical or similar investments of the same issuers. For example, the company has issued two types of stock, stock A or stock B. You have invested in the B. For B, market values are not available, that's the but for A is available. Right? And for example, you bought it for $100. Now the market value of A is $112. So it means I can say this observable changes is $12. Right or wrong? Of identical or similar securities of the same issuers. So what I will do, I will add this $12. If market value, you bought it for 100, but market value is 88 of similar or identical securities. So I will then deduct this $12 to get my measurement alternative value. Clear? So what is the formula? Just it is, I can just give you this simple example. You want to buy Coca-Cola company. Let's assume Coca-Cola company price is not given. So you can use Pepsi company. You can adjust your value, right or wrong. Maybe Pepsi is bit in larger in size, let's assume, or smaller in size. According to that, you can do plus minus adjustment. But for you guys, just you have to remember theoretically. What is the format? Cost of investment minus impairment plus minus. What is plus minus? Observable price changes of the identical or similar investments of the same issuer. Same issuers, if you will have. Otherwise, in your exam questions, the market value will be available. Simply, the example first which we did, similar type of question will appear. Just they can test this as theoretically. Understood? Because this plus minus changes is your estimation actually, right? So here we go, guys. Now I want to tell you about equity method. Equity method. See, I will explain equity method, whatever is required at your level. Right? For CMA, to solve the question at CMA level, whatever we need, that information I will share. Otherwise, it is a bit long also. There are some extra information. But for you guys, that is not required. This information, whatever I'm going to share with you, it's more than enough. Okay? So here we go. Otherwise, if you want to get more information, so I have one video on YouTube with the name of equity method of investment. You can watch. That is more detailed, but for CMA, it's not required. For CMA, whatever I will explain, that is enough. Okay? So here we go, guys. Equity method. So we are talking about equity method. First of all, when you can apply equity method. Because whenever your investments, voting rights are between what? 20% to what? 50%. So here you have significant influence over the investee. Right? Significant influence means that you have a power to decide or participate in the policies of the investee. And here you got how many options? 2 options. You have fair value option and you have equity method. Fair value option, how it will work? Similar as we discussed fair value method. Similar, no changes. Like in balance sheet, you will record investment at market value. Changes you will take into the profit and loss account. Same you will follow. But only if you have opted for equity method. If you have opted for equity method, so then how you will work, this is what I'm going to explain. Equity method, you can simply assume to understand. You can simply assume it is like your bank account. Like for example, you invested some money into bank account today. As you will earn interest, bank account balance will increase. As the bank will deduct some charges, bank balance will reduce. So same idea, same mechanism we are going to follow. Here, fair values of the stocks are not relevant. Fair values are not relevant. Cost is relevant. What you have paid at the time of acquisition. Later on, whatever profit share you will get from investee, or loss share you will get from investee, or dividend which you will receive from investee, that will be adjusted in the cost. Okay? Fair values are not relevant here. So how it is going to work? Here we go. This is equity accounting entry is relevant to the equity methods. Number 1, first note, and equity investments, even you're using equity method, is initially recognized at cost. Obviously, cost means whatever you have paid, including transaction cost. Right? Clear? So what you can do, when we buy the stock of other company, for example, first entry, and I'm assuming here we bought how much percentage? 30%. Please need concentration now. It's easy. For example, we purchased 30% of the voting rights and we have elected to opt equity method of accounting. So what entry we will pass? We will debit investment in X company. It's equity method investment. Okay, and credit what? Cash. Again, this Investment means it's your asset. Right? Then guys, what you will do? You will wait till the end of the period. And at the end of the period, your investee could have either profits or what? Loss. And your stake is 30% in my example. If investee will have profit, you will get 30% of the profit share, like a partner. If investee will have a loss, you have to also take the loss share as per your voting percentage, which is 30% in my example. Right? And how you will get share of profit or loss? So share of profit and loss, this is how we can calculate. As I told you, at the end of the year, investee will either have profit or loss. So we have to calculate our share profit of our share of profit or loss. Our means investor's share in the profit and loss of the investee. So how you will get? Very simple. Share of profit and loss. So you will take first of all profit or loss value of the investee. From where you will get this? From investee's income statement. Right? Because profit and loss of the investee is available in investee's income statement. Take that value, multiply your holding percentage. I'm assuming we have a profit of 100,000. You could have loss also, but I'm assuming investee is having a profit here, 100,000 for the year, and we will multiply with 30%. Okay, so this is, it means our share of 30,000. If this is the loss of 100,000, multiply by 30%, this is going to be a loss share. Right? If you have a profit share, if there is a profit share, what entry you will pass? You will debit the investment. It is same like you have earned the interest on your bank deposit. So it will be obviously increase, it will increase your bank balance, right or wrong? So you will debit the investment and you will credit what? Revenue. Revenue is a share of profit, right? Share of profit, and this will be taken to the income statement again. Whose income statement? Investors, because you are receiving money, you are taking profit share. So you will increase your investment value and you will credit the revenue, not mainstream revenue. It could be other income or revenue from investment, any word you can use. It's not revenue from sale. It's revenue from investment. You will record in your income statement. But if you have a loss, what entry you will pass? You will debit the loss from investment, and credit what? Investment account. So what happened here? Remember theoretically. With the profit share, your investment value will increase. And with the loss share, your investment value will decrease. Because in profit share, investment account was debit. It's increasing, right? In loss share, investment account is credit, it will decrease. Understood? So then guys, we have one more entry. When investee declares the dividend, or when you will receive the dividend. So what entry you will pass? You will debit the cash if you have received a dividend receivable, and credit what? Investment. You will credit same like as they have deducted bank charges. Because look, what is the idea? Dividend on investment under equity method is treated as return on investment. Return on investment. It's like as you have withdrawn the money from the bank account, right? It will reduce your bank balance, right or wrong? Previously we added profit share. Now we will deduct what? Dividend, whatever we have received, because we are receiving from the same profit, right? Right or wrong? Here make sure what examiner will do. He will tell you total dividend of investee. Like investee has declared, for example, 20,000 dividend. So you will multiply with your holding percentage. So whatever your share, for example, 6,000, I'm not sure if 6, whatever. So if let's say if it is 6,000, so with this 6,000 you have to debit and you have to credit this entry. Clear? Now we will summarize here. So what we have learned here, Please, these are also note, dividend from the investee is treated as return of the investment and it has no effect on investors' income because this dividend you're receiving already from the profit share. Right or wrong? Because you have taken first profit share. I cannot add dividend one more time. Why I cannot add? Because I have added already profit of the investee into my investment account. And from that profit dividend will be paid, which I will use. You got it? Then what you will do here? If an investor can no longer be presumed to exercise significant influence, for example, maybe previously you hold 30%. Now you sold 15% of that investment. Now your remaining percentage is how much? 15. So you will categorize in first category between 0 to 20, right? Which method you have to follow now? Fair value measurement. Understood? Then guys, this statement you need to memorize for equity method because mostly questions will be from this equation. So first of all, we will take opening investment value, which has been recorded at what? That's in cost, if it is your first year of investment. Otherwise, opening investment value you can take from the recent balance sheet, last year's balance sheet. Then you will add here what? Plus share of the investees profit. I told you how to get share of profit. You will take investees profit times holding percentage. Or if you have a loss, you will deduct share of loss. Please remember, share of profit, you can see arrow, increase the investment account. And share of loss, decrease the investment account. And then you have a dividend. Okay, so you will deduct, it decrease the investment account. This is the value of your closing investment. Okay, understood? Clear? Now guys, here, this is what is about equity method. If you remember this story only, so this will be more than enough. I will show you some questions. Let's finish the topic first. Okay, I have said is clear, right? So equity investment for equity securities is over. Now we are going to talk about investments in what? Debt securities. Let's cover it first, then I will show you a couple of questions. See how things are going to work. Investment in debt securities. That means to say, please remember here, guys, like bonds or preferred stock. So what it is, debt security represents a creditor relationship with the issuer. Obviously, if I'm issuing bonds, it means investors, for me, they are creditors, right? Finance provider, and I have to return this money maybe in the future. And periodically, I will pay interest also, right? So here, in addition to the common form of debt, because under debt securities loans, obviously, bonds are debt security. In addition to that, the categories include what? Like under debt securities, what it will include? Mandatorily redeemable preferred stocks. You know, preferred stocks could be irredeemable, could be redeemable. If mostly it is irredeemable, we say it is equity. If it is redeemable, we say it is a debt because we have to return like a loan. Okay, it might include preferred stocks redeemable at the investor's option. Sometimes, we issue the preferred stocks. We say it is redeemable. Whenever you want, you can take your money back. So this is also redeemable. It's like a loan. It's debt security. And then what? Collateralized mortgage obligation. Sometimes, we provide security, we take loan. That is also debt, right? Please guys remember, leases is not your debt securities. Options, financial future contracts, what these are, actually these are some derivatives, which is not here, by the way. You will study in part 2 in finance section, right? So forward contracts, it's also part of those derivatives topic, are not a debt security. For you, just you have to remember 2 words: bonds and preferred stocks. Bonds and preferred stocks are your debt securities. This preferred stocks, redeemable. Okay. Now, when it comes to the accounting, guys, when it comes to the accounting for debt securities, accounting depends on three categories. Like whenever you buy bonds or preferred stocks of other company, so first you have to classify, is this investment is held to maturity? Is this investment is trading? Is this investment available for sale? How you will categorize now? It's not hard data. It's on your wish. Wish in a sense, you have to remember this point. Held to maturity means say what? First of all, held to maturity, mostly it includes bonds. Only bonds. Mostly. It includes what? Bonds. For example, you have issued the bonds. I'm the investor. I purchased the bonds. I have invested into your bonds. And these bonds are having 5 years life, maturity life, 5 years. And when I bought, I have intention that I will keep these bonds for 5 years. I'm not going to sell it before that. If I have this intention to hold until the maturity date, so then this security should be classified as held to maturity. Understood? So what's written here? Go through. Debt securities that the reporting entity has the positive what? Intention and ability to hold to maturity. Like here your intention is to hold until the maturity date. Okay, so this is what is called your held to maturity category. Second is what? Trading categories. Trading securities. How it is going to work? Debt securities intended to be sold in near term, it's a short term. Maybe today you bought at less price and you feel whenever price will go up, I will sell it and I will make money. Now I don't know, it will go up after 1 month, 1 day, 1 hour. But I have intention. I will sell in near future, near term. So then it is called which securities? Trading securities. Understood? And then we have here what? Available for sale security. Okay, available for sale security. Available for sale is what? If you bought the bonds or preferred stock and you are not sure you are going to keep it until maturity, and you are also not sure you are going to sell it in near future, it means it is not classified as held to maturity or trading. So then that can be classified as what? Available for sale security. So that's why it's written here, debt securities not classified as held to maturity or trading will be treated as available for sale category. We are not sure like when it will be sold. So then it is available for sale category. Understood? Please let me tell you here, held to maturity securities accounting for this held to maturity. We will cover under unit number 4 for this category. The reason, there we will study this topic bonds because it includes bonds. We will study this topic from issuer point of view. Like when company issue the bonds, what accounting they will do. And same data can be used from investor point of view. Same data. Because if issuer is receiving money, investor is investing money. If issuer is paying interest, investor is receiving interest. Right or wrong? If issuer is maturing the bonds, investor will receive the money. Amounts are the same, just entries will change. In one's books, it will be liability, in other books, it will be asset. In one books, it will be interest expense, in others book, it will be interest income. So that is why bonds topic we have properly in unit number 4, there I will teach you. Whenever I will teach bonds, I will teach you held to maturity securities also accounting. Just remind me that time, one time. Huh? It's in my mind, but in case if I will forget, just remind me. I will explain that answer. So it means today I can cover. Today we can cover here what? Trading and available for sale security. And if you will do the question from software, any question which you will encounter regarding held to maturity, just skip so far. Huh? Just skip. Don't try. You will try only equity method questions, fair value measurement, fair value option, or this what? Trading are available for sale securities. Any questions regarding HTM, held to maturity, just ignore. Even in your book, for this topic, in this chapter is theories written only, because calculations are explained in unit 4. So we'll go through there. So then guys, here we have, first of all, as I told you, held to maturity will be covered in unit 4. So whatever is written here, just ignore. Okay. So you have to start it here. Trading securities. Okay, trading. Trading securities, it's also called, here also you are going to apply which method? Fair value method. Please remember guys, under trading securities, both could be there, bonds and preferred stocks. Bonds, and he might give you a question of bonds, like maybe you have invested in bonds or you have invested in preferred stock. So this is, and it is also called trading securities through what? Profit and loss accounts, or through the net income. Actually, it is same fair value method. What? Fair value model or method. Same to same, just slight difference is there. And the changes in fair value, you will take where? To the net income. Net income, it's to the income statement. And each trading security is initially recorded at cost, as we studied previously also, because it's a fair value model, including brokerage commission and taxes also, because it is going to be the part of cost. Right? Understood? So first, let's understand the entries. Then we will do the question here. Guys, first entry is the same. When we buy trading security, then we will buy trading security. We will debit what? Trading security as investment. It's your investment, obviously. But I'm using just word trading security as investment account. Credit what? Cash account at cost. Whatever you have paid, including brokerage commission and taxes if you have paid. Got it? Now, because it's a fair value model, at the end of reporting date, as I told you, maybe you bought it for 10. Now fair value is maybe 12. You have a gain of $2. Here guys, please remember, for trading securities, we will create 2 ledgers. This is the difference actually. How many ledgers? 2 ledgers. First ledger is for cost account, in which you will keep just your original cost. First ledger. Second ledger is for what? Fair value adjustment account. Fair value adjustment account. In this ledger, in fair value adjustment account, so we will just record the changes in fair value. Changes in, if I will take cost, original cost, for example, original cost is 10, and here we have a $2 gain. I will add fair value adjustments, it will be equal to $12. If I have a loss, I will deduct $2. It will become what? $10 or $8. Understood? So fair value adjustment is a separate ledger. We will not touch this ledger for fair value changes. Fair value changes will be recorded in fair value adjustment account. So that is why in balance sheet you have to record your investment like this. You have to show first what? Cost plus minus fair value adjustment. Plus minus, why I'm using word? It depending upon it's a gain or loss. So automatically it will be equal to fair value at reporting date. Once I will take cost plus minus fair value adjustment, it will be equal to fair value at reporting date. Understood? So this is what we are going to do. So that is why if there is a gain at the reporting date, if there is a gain, even realized or unrealized, whatever. So far I'm assuming it is unrealized, because at the time of sale, what you will do, I will tell you. If you have a gain, what entry you will pass, you will debit fair value adjustment account. Don't debit here trading security itself. And don't touch the cost account. Fair value adjustment account. And credit what? Unrealized gain. And gain will be taken to the income statement again, because through profit and loss we are studying. And if there is a loss, what entry you will pass? Debit unrealized loss, which will be taken to the income statement. And credit what? Fair value adjustment account. You will have only one situation, either gain or loss. Two situations are not possible at a time, right? You have a gain or loss all together. No. One situation will be there. Remember the entry. Right? Then entry number 3. Dividend on stock. Because if you invested in the preferred stocks, you might receive dividend. What entry you will pass? Debit cash or dividend receivables. Credit what? Dividend income, which will be taken to the income statement. At the end, I will summarize all topic, don't you worry. Then we have what? Interest on debt. If you have invested in the bonds, you might receive interest on that. So debit will be again cash or interest receivable, and credit will be interest income, which will be taken to the income statement. Understood? Same entries, right? Just slight difference. Fair value adjustment account, we have extra here. Okay. Then when we sell the investment, so what I will do, I will debit the cash with the cash proceed, whatever I'm receiving at the time of sale. I will credit trading securities with the carrying value. Carrying value means a cost plus minus fair value adjustment account. This is your carrying value, or which is fair value also in last balance sheet. Right? With that value, I will remove it, investment. And then guys, if difference is coming on debit side, it will be a loss. If it is on credit side, it will be a gain. So gain or loss, realized gain or loss will also be taken to the income statement. Ready for question? So here we go. Let's do it first. Example. Let's finish the topic first. Then I will take you to the question side. So here we go. This is summary, guys. In balance sheet, I told you, you can record investment at what? Market value at as current assets, trading, because near future you will sell it. Right? In some books, it's written it is current or non-current. Again, it depends on the nature and the purpose of the investment. But preference should be given as the current asset, because near term it's decided. Right? Then what? Income statement. So you will take all gains or losses, even it is realized or unrealized, will be taken to the income statement along with interest and dividend. Then statement of cash flows. Okay. So classification of cash flow statement again depends on the nature of the securities and the purpose of their acquisition. It's investment or operational activities. Mostly we write under investing activities. Okay. Clear? Here we have one small question to practice. Here we go. I hope so it is visible, guys. We will solve it now together, guys. So first I would request, please go through this, or I'm going through. So on October 1, year 1, Maverick company purchased 1,000 shares of Larsen. Which shares? Mandatorily redeemable preferred stock. It's debt security. At fair value, whatever the fair value is prevailing at October 1st, year 1. Understood? Maverick classified this investment as trading securities. As trading securities. It's given now, you have to follow fair value method, obviously. On March 1, year 2. Year 2. Maverick sold all of its investment. Okay, you sold all of your investments at what? Fair value which is prevailing on March 1, year 2. These are the fair values on the relevant dates. October 1, which is your date of purchase, year 1. So you purchased for $15. Then 31st December, year 1, this is the first year end. Stock price was 14. Then this is the date of sale. You sold it for how much? 21. Ready? So here we go. First of all, you have to decide two things. We are sitting on October 1, year 1, which is date of purchase. You purchased how many stocks? Preferred stocks, 1,000. What was the value? 15. So you will debit the investment, I mean, say trading security, or credit the cash of 15,000. Done? Now at the end of first year, right after maybe 3 months, what happened? Stock price has reduced by $1. From 15, it came to the 40. So guys, now this is a $1 loss. Loss again, loss. Unrealized loss, right? Because you sold it in March of year 2. So how many stocks are there? 1,000. So there is $1,000 the loss. So what entry I will pass? I will debit the loss, unrealized loss of 1,000, but I will credit fair value adjustment account. Understood? Now tell me the presentation of year 1. What you will do? Year 1 presentation. First tell me in balance sheet what you will do. You have already under asset section. Okay, you have a cost. How much? 15,000. This one. Trading securities at cost, right? Trading securities at cost. Plus minus fair value adjustment account. And adjustment account is debit here, right? Or credit here? No. Fair adjustment account is credit. So it means you have to deduct. It's a loss. You have to deduct of how much? 1,000. It will be 14,000. Your carrying value, your fair value. Here carrying value and fair value same. Reason? Because total stocks are how much? 1,000. And what was the fair value at that day? 14. It will be 14,000. So it means carrying value and fair value will be the same, right? Understood? Now what happened, guys? In income statement, what you will do? This $1,000, which is the loss, will be taken to the profit and loss account. Got it? Clear? Now here we go. What happened in March 1, year 2? You sold it for how much? 21. And don't forget, in your recent balance sheet, in year 1 balance sheet, investment is showing at 14. This is what you have to remove at the time of disposal. Right? You sold it for how many dollars? 21. If you look at here, from 14 to 21, there is a gain of 7, right? Because value has increased. Times what? 1,000 shares. 7,000 is the gain. Right or wrong? Do you want to book gain separately? No, we will book the gain with the disposal. We can book together. No need to book separate. So first I will do what? I sold it for 21. This I know. What entry I will pass? I will debit the cash with the cash proceed. 1,000 shares I sold with the price of 21. It is 21,000. Credit the trading securities at 14,000. Why we are crediting? Because we want to remove the asset from the balance sheet because it is sold. And now you can see here there is a difference between 21 and 14,000, which is your gain on credit side. Right? So gain of credit. So this will be taken to the income statement. Understood? This is how you will work. It's same fair value model, just slight difference. You are creating one extra ledger adjustment account, fair value adjustment account. That's it. Otherwise, there is no special things or some rocket science. No. Okay. Now I'm going to tell you available for sales securities. So, guys, let me here prepare small summary for you. Small summary, and then we will move to the available for sale. You can see here what's going to be different here. Don't forget. I'm talking about first equity method. Let's summarize within 2-3 minutes. And then we will move to the available for sale because there are some changes are there. First of all, we studied for equity securities. Equity securities, we discussed there which method? Fair value method. If it is a fair value method, what I told you, so in balance sheet, you will record your investment as asset at fair value, which is prevailing on the balance sheet date, right? Right or wrong? Then what we studied in the income statement, I told you all gains are losses. Gains are losses. Either it is realized or unrealized. You will take it to the income statement. Plus, if you have received dividend, dividend will also be taken to the income statement. Understood? Clear? Then I'm going to tell you about what? Measurement alternative under equity section. What? Measurement alternative. What was the formula? Cost of asset minus impairment of investment plus minus observable changes in the fair value of the identical or similar securities of the same issuer. Is the condition. Practically, no one is using this, honestly speaking. Okay? But GAAP says do this. Otherwise, what is the best option? It could be the option. I'm not saying it in the standard. It could be the option recorded cost only. If variable is not determinable, because don't make it more subjective. Right? Subjective, so when you do plus minus changes, it becomes subjective. Because you might add more, I might add less. Right or wrong? So here, guys, then what we have here? This is equity securities, right? Then we discussed about debt securities. Under debt securities. Under debt securities, we have 3 categories. Category number 1, held to maturity. We didn't discuss anything about this. Category number 2 is what? Trading securities. So this is what I'm going to talk about. Trading securities. Trading securities. See what is going to be different here. It's similar. So in trading security, what we will do in balance sheet? We will record our investment as asset at which value? At fair value prevailing on the reporting date. Right? Then in the income statement, what we are going to do? All gains are losses, both realized plus unrealized. We will take it to the income statement. If you are receiving dividend, will be taken to the income statement. If you are receiving interest, will be taken to the income statement. Right? Now I'm going to tell you about what available for sale securities. Let me tell you first in summarized way, then we will go through entry and example. So in available for sale security, please remember the rule, guys. What's going to happen? Available for sale securities. First, I want to tell you here about gain or losses. And there are 2 types of gain or losses, realized and unrealized. So I'm talking about unrealized gain or losses. This will be taken to other comprehensive income. Where? Other, because other comprehensive income is the part of statement of comprehensive income. I'm not sure we studied this in unit number 1, if you remember it. Right, other comprehensive income. You will write where in the other comprehensive income, not in the net income, and not in the income statement itself. Because income statement plus minus other comprehensive income is called statement of comprehensive income. Just remember where you will write in other comprehensive income. I can see your faces, maybe some students, they don't know about this. At least you can remember this point. It will be written where in the other comprehensive income. Okay. If you have a second thing, if you have a realized gain or losses, what? Realized gain or losses. Realized gain or losses will be taken to the income statement. Okay, understood? Now, guys, actually there's a one statement of comprehensive income which is equal to net income, which we get from where? From the income statement, plus what? Other comprehensive income. There are 4 items under US GAAP. The gain or loss on available for sale securities unrealized. You will write in other comprehensive income. Gain or loss on pension. Gain or loss on hedging instruments. Right? So there are a couple of items which you have to write only under other comprehensive income. So this is one of them actually. And then this net income, when you, because this profit and loss, you also transfer to the equity section, right or wrong? Right or wrong? This net income always transferred to the retained earning of the equity section. But this other comprehensive income is transferred to the accumulated other comprehensive income account in equity section. If you don't know these things, no worry, just remember at least whatever I'm writing. Okay. Now, this is income, this is OCI and income statement effects. Now, guys, I want to tell you about effects of balance sheet. In balance sheet, now there will be 2 things. One thing will be what? Investment as asset. And same 2 ledgers you will maintain. Cost and fair value adjustment. Investment as asset, right? As this is as asset. Same 2 ledgers. Cost plus minus fair value adjustment account. So this will be equal to fair value, which will be equal to the carrying value. Right? Plus under balance sheet. In equity section. Which section? This value, this, what is this value? Unrealized gain or losses will be written under equity section also. With the name of accumulated OCI. Because I told you this OCI item transferred to accumulated OCI in equity. And net income is transferred to the retained earning in equity. There's the change, huh? Understood? Just repeat with me. Realized gain, where we will write our loss? Realized income statement. Great. And it will affect retained earning in equity. Because income statement will affect retained earning. Unrealized gain or losses, where you will write? In other comprehensive income. And it will affect accumulated other comprehensive income in equity also. Right? Okay. Then guys, in balance sheet I told you what? You will show investment as asset, plus you will show in equity as a reserve, OCI reserve. Understood? One thing I skipped and no one is noted. In income statement only gain or loss will go? No. In income statement, what will go? Dividend also. Plus what? Interest also, that will also go to the income statement. Okay? Understood? So now if I will ask you in one word, what's the main difference? Under trading and available for sale, you would say unrealized gain or losses. Under trading income, realized or unrealized both will go to income statement, but under available for sale, only unrealized will go to other comprehensive income, realized will go to income statement. Understood? There is the difference, huh? I hope it is clear. If it is not clear, no worry, I'm going to do the example with you and see how things are going to work. And I will follow the same sketch which I have written here. Okay, here we go. First, relevant entries. Entries, we can also go through these same entries. Entries are the same as we discussed previously, right? So we can go through with the help of example. First entry is what? Same entry. When you buy the security, you will record what? Available for, we are using, actually it's investment, but trading investment available for sale, we are using word intentionally to differentiate in the balance sheet. Is it trading? It is available for sale. And credit what? Cash with the cost. First entry is clear. Second is what? If you have a unrealized gain, not realized, unrealized gain, you will debit fair value adjustment and credit what? OCI, other comprehensive income, because you will record it there. If you have an unrealized loss, you will debit loss, means say OCI, not to the income statement, and credit what? To fair value adjustment. Understood? And then whenever you will receive dividend, or you have a right to receive dividend on preferred stock, you will debit cash or dividend receivable, credit what? Dividend income. And then why, guys, what we have? Interest. Debit cash, credit what? Interest income if you have received on bonds. When we sell the investment, we will debit what? Cash with the cash proceed, whatever you are going to receive, and credit what? Available for sale securities with the carrying value or fair value of the recent balance sheet. And now there is a one more account, what? OCI. You will not understand why it's debit until unless I will do the example. But there will be one thing, go to OCI also. If any gain there in equity section, because listen me what I'm saying. Concept will be more clear with example, but theoretically I'm explaining. When you sell the investment, when you sell, investment should be removed from balance sheet, right or wrong? And in the balance sheet, there are two accounts, two sides. In asset side, it's also reflected. In equity side, it's also reflected. To remove the asset, we credit the available for sale security. To remove the equity, equity is normally credit. We will debit this OCI. Okay? Then it will be completely removed from the balance sheet. Understood? And now if there is a difference, your entry is not tally. If difference is on debit side, that is loss realized, which will be taken to profit and loss. If difference is on credit side, that is gain, which will be taken to profit and loss account, not to OCI. Clear? Understood? If not, let me do example with you guys. No worry, we will cover it. And in statement of cash flows, guys, it is which activities? Mostly it is investing activities, obviously, because it's your investments. So we have example here. Yeah. Let's go through example, guys. It's big. More entries are there. So we will go through together now. Only one slide difference is there. Otherwise, it is same fair value model. Just unrealized, I have to be more careful about unrealized gains. I have to take it to OCI. From OCI, it will go to equity also. So here we go. On April 1, year 1, Maverick purchased 1,000 shares of White Corporation, mandatorily redeemable preferred stock at fair value. Maverick classified this investment as available for sale. You bought in year 1, April 1, year 1. On May 1, year 3, in year 3, not in first, not in second, in year 3rd year, Maverick sold all of its investments at the fair value on that particular date. And these are the relevant fair values are available. On April 1, year 1, right? April 1, year 1. Fair value is how much? 25. This is the date of purchase. Let's go to one by one. So what entry I will pass? Because I bought how many shares? 1000 shares. Right? At which price? 25. So how much? 25,000. What entry I will pass? Debit investment. I mean, it's available for sale security and credit cash by 25,000. Done? Any problem? No. But in year 1, your price has increased to 32. What's the gain? 7. How many stocks? Gain will be. So debit will be what now? What will be debit? Fair value adjustment account. Don't do to the cost. Fair value adjustment account debit. And credit will be unrealized gain. Gain will be taken to OCI. Debit and fair value adjustment. Okay, that's 7,000. Done. Now you will tell me. Let's prepare balance sheet year by year. Because there are 2 to 3 years data. So let's go through. This is what year 1 we are doing now. Year 1. First, I'm preparing balance sheet. Or do you want income statement effects? There is nothing will go to income statement. It will go to the other comprehensive income under statement of comprehensive income. Okay. Actually, what I'm trying to say there is a statement of comprehensive income in which net income will be written and in which what will be written? OCI. Under OCI, I have to write. I have to write gain, unrealized gain. Unrealized gain of how much? 7,000 as a positive value. Okay. Right. Now, guys, balance sheet. On asset side and on equity side. First, everything, just write this. In equity, under the heading, because in equity you have share capital, additional paid in capital, retained earning, reserves, accumulated OCI. Under accumulated OCI, you will write here what? 7,000 positive value. Now move to the asset side. In asset side, what you will do? You will write cost of 25,000 plus minus what? Fair value adjustment account. It was gain, right? Gain of 7. It will be equal to what? 32,000, which is fair value actually. Because at reporting date, fair value was how much? 32,000 shares were there. So it is 32,000. So fair value and carrying value will be the same, right? This is year 1 extracts of the financial statements. Understood? Clear? Now year 2. Let's move to the year 2 data. So in year 2, stock price became how much? 27. It means from 32, it reaches to 27. Loss or gain? Loss. How much? 5 or 4? 5. How many stocks? 1,000. So total loss is 5,000. Now see what I'm going to do. First pass the entry. What will be the entry? Debit unrealized loss, credit fair value adjustment account. Right? By 5,000. Understood? Here we go. Now year 2 financial statements. Year 2 I'm preparing now. Year 2. First in under statement of comprehensive income, you have net income plus minus what? OCI. In OCI, 5,000 loss will stand as a negative value. Understood? Clear? Okay, now what you will do? And here now we are preparing balance sheet. In balance sheet, you will have what? Asset, and you will have. Tell me, equity account is closed every year, or it will have carried on and brought down balance. Assets, liabilities, equity will have carried on and Brought down balance. Last year, what was equity? Under equity, there was a accumulated OCI. How much it was? 7,000 balance were there. And now 5,000, there is a loss. So remaining balance will stand as 2,000. Done. It means now in equity, you will have a balance of 2,000 under accumulated OCI heading, right? Now in asset side, cost is not going to be changed. That is going to be 25,000. And last year, fair value adjustment have a balance of how much? 7,000. Because it was double last year. This year, fair value adjustment account is credited due to loss by 5,000. So we'll deduct 5 also. Again, how much balance in the fair value adjustment account? 2,000. It will be how much? 27,000, which is equal to 1,000 shares, and market value at that date is 27 at reporting date. Understood? 2 years are done. It means asset, the investment as asset is 27,000, and equity, we have balance of 2,000. Clear? Now look what happened in third year. I have seen your understanding, right? Third year, what happened? Again, your price has 31, but you sold it. This is actually the date of sale. This is the date of sale. So what entry you will pass now, you will tell me. I'm going to just guide you. Year 3. Because you sold in the mid of the year. You sold it for how much? What is the price? 31. Okay. So look what will happen now. Entry, let's pass the entry. Debit will be a cash account. You know, you sold 1,000 shares at 30. Any doubt? No. Now you have to credit investment account are available for sale account with the carrying value, and in the recent balance sheet, it was showing at 27,000. So credit by 20,000. And there was an equity in balance in equities was how much? 2,000. And equities nature is credit. If I want to eliminate, it will be debit. So we will debit accumulated OCI because it is under into that account or equity account, anywhere you can use, but you need to remove. My point is you have to remove by 2,000. Entries tally. Debit side is 33,000. Credit is 27. So difference is 6,000. So this is going to be your gain. Which gain? Don't say unrealized. It is realized, and this will be taken to the income statement of the third year. Right? Now, some students might have a question how this gain is 6,000. Actually, it was 4,000. Why? Look. Because in recent it was showing at 27 and now its value is 31. So it should be $4 times 1,000. Gain should be 4,000. How it became 6? Because the gain which was parked in equity 2,000, that also realized. For this to that, the total is 6,000. Understood? Okay, clear? This is called what available for sale securities. Guys, there is a one topic which is called transfer between debt securities. Like what you will do if you will transfer from held to maturity to trading, or from trading to available for sale. For CMA, it's not required. Okay, you can just simply skip. But if you want video, I can provide. I have recorded the video for that. Okay. So you can directly watch from my YouTube channel also, it's recorded there. But for you, no need to waste time. Only important thing which you should do, those should be done. If you are CPA student, then that topic is important. Okay. So now guys, here, let's do some couple of practice questions and let's see what we have understood. Okay. So guys, So we have a quick question, guys. So here on December 31st, O company had invested in equity securities as follows. So this is what you have invested in Man company, K company, and F company. This is your cost, but these are the fair values. This is which securities? Equity securities. O December 31st balance sheet should report the equity securities as which value will report, because it's not, there's no data about equity method, etc. We are assuming fair value method here. So we have to record all the investment at fair value, which is going to be 28,000, not at cost. But if I will ask you what is the total gain which will be taken to the income statement. So because your cost is how much? 30, fair value is how much? 28. So there is a loss of 2,000 which will be taken to the income statement. But in balance sheet, it should be reported at 28,000, which is the question here, because I'm talking about fair value. So let's do the question about equity method. Let me show you. Here we have another question. Let's first read it, please, guys. So company owns how many shares, guys? 10,000 shares of the corporation stock. The corporation currently has 40,000 shares outstanding. First get the percentage of voting rights. Okay? Percentage, because you purchased how many shares? 10,000. Total stocks of that corporation is 40,000 multiplied by 100. So your holding percentage is going to be 25%. Equity method you can apply only if your percentage is between 20% to 50%. So here we got 25%. Right? Now, guys, here they're telling you during the year, corporation had a net income of 200,000 and paid 160,000 in dividend. At the beginning of the year, there was a balance of 150,000 in the company's equity method investment in the corporation account. This is the beginning investment, right? What is the question? At the end of the year, the balance in the account should be in equity balance. What is the value of investment? So write the equation: opening investment plus share of profit minus share of dividend minus dividend is equal to what? Closing balance of investment, which is asking. Right? Opening investment is given here. Where it's given? Opening investment 150,000. Plus profit share you have to take. What the corporation has profit? 200,000. And your percentage is how much? 25%. So it will be how much? 50,000 will be added. Check the arithmetical accuracy, okay? And dividend. Total dividend what declared was how much? 160,000. But your share is how much? 25%. So it is going to be whatever value. Can you tell, please? 160 times 25%. 40,000. Just deduct. This will be your closing value of investment. 150 plus 50 minus 40. It's going to be 160. Which is correct option? C. Okay. Sometime he might give you closing balance he might miss any one value from these three: profit share, a dividend, or opening investment value. So you have to go reverse then, right? When you go reverse, plus will become minus, minus will become plus. For example, you want to calculate share of profit. Other data is given. So on my calculator, what I will do, I will take 160,000. This is negative value, I will plus 40,000. This is plus value, I will minus 150. On my calculator, automatically I will get 50,000 as a balancing value. Okay, guys, please keep trying the questions, but I would suggest first read the material. Okay, then go through the questions. So next class, we will talk about property, plant, and equipment 3.4. Thank you so much, guys. Thank you so much.